Welcome to the sequel for gold over $5,000 an ounce coming soon. This is that of the second part. The first part was recorded in 2009 on May the 17th of that year, and there's a lot of good information in the first part. I will not be going over really that much of the fundamental analysis that was covered in the first video. And I also did a video on the 2nd of June of this year, which is very important. The link to both of these videos will be located in the more information box on the YouTube browser, but this timeline goes back to 1792, so over 200 years of different dates and specific happenings that occurred. Very important information which will show a lot of the manipulation and suppression that is going on within the gold market. Now, the $5,000 an ounce prediction, there has been several people who have went out and made predictions for around that price or exactly that price. And other than one, I'm not going to mention any of them. If you do some searches, you'll find a lot of them, and they're pretty much all going to refer to the exact same reason. Now, the one that I'm referring to is actually from CNBC, so I'm using a mainstream media outlet, nothing by Max Kaiser or nothing by Mike Maloney or any other one who is very bullish on gold. This is CNBC, but I want to go over what you can read and see in the mainstream media. Let's go over the first paragraph, and I want you to tell me where the lie and where the truth is revealed. An exhaustive report by Standard Chartered predicts that gold will more than triple to $5,000 an ounce because of lack of supply. Not just because of a surge of demand that most bullion bugs cite in their bullish calls. So again, we're looking for the truth and the lies just by looking at how the words are presented in the first paragraph. Well, let's just look at it this way. They're saying it's going to go to 5,000 because of a lack of supply. Now, let's just start with the not just. Not just because of a surge in demand that most bullion bugs cite. Now, let's look at this. How many bullion bugs would say the only reason is because of surge in demand? And if you give them any other reason that's not based in the demand surge, are they going to say, no, 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 no? Of course not. If you look at exact words, the word just, that means they're saying that most bullion bugs only think there's one reason for it to be going higher. There's the lie. And the truth is lack of supply. Now let's look at what this lack of supply really means. Now, why is the supply very low? Is it because they're not mining as much as they previously did, or at least into accordance of the population? Well, I'm sure that's possible. Now, does any of it have to do with how much gold is actually in Fort Knox as well as other places in the world that is holding investment gold? And of course, the currency supply, as it's been rising and rising and rising, that means there's more of those digital and fiat paper dollars out there. And of course, that means they're worth less and less. Thus, of course, lack of supply. Moving on to the second paragraph and the final one that I will go over, and that is, there are very few large gold mines set to commence operation in the next 5 years, said Standards analyst Yan Chen in a report Monday. Of course, this was back over a year ago. The limited new supply comes at a time when central banks have turned from being net sellers to significant net buyers of gold. The result, in our view, will be a gold market in deficit. Even assuming flat growth in demand, with the supply-demand balance so out of kilter, we see the gold price potentially going to $5,000 an ounce in U.S. currency. Now, again, the significant point is banks going from net sellers to net buyers, which is, of course, very important to realize itself that a lot of them know what's going on, and this is one way, of course, protecting against what is inevitable. Now, most of this, or for the rest of this video, I'm going to be going within the charts, and there's quite a few charts to go over. But let's go back to where I left off, because it was May of 2009, and I'm on here stating gold is going to, well, $5,000 per ounce. And at the time, gold was $931, and it was in a very beautiful bullish pattern. And one of the things I was talking about back then was an inverted head and shoulders pattern. An inverted head and shoulders pattern is where you make a move like this, where you develop a cup, and then you develop one that's larger, that breaks below the previous low, but it comes back to the previous area where it found resistance, and then it repeats the first cup over again. That pattern is extremely bullish. There were people that were stating in an uptrend, it doesn't work. Well, I guess that was proven wrong, because once it got past this 1,000 level, it was off to the races. Let me explain this chart a little bit and everything that you're going to find on there. This is a weekly chart. That means one candle represents 1 week, and each one of these has 100 periods on it. So if I say I'm going to show you a daily chart, each candle represents a day, and there's 100 days on there. There's 100 weeks within this chart. The blue line, that's got a band and the blue dots in the middle, that's the 18 average, and that shows the 18 average of highest prices on the top, average prices of closes in the middle, and average prices of lows on the bottom. It's a front-weighted average price, which is a little different than the exponential and the simple, and it's the favorite one that I use. The upper and lower bands is made like the Bollinger Bands. It's an algorithm of different formulas based on the volatility that the market has, as well as where the 18 average is. I find it a very great tool to use, as well, of course, as these lines. These are Fibonacci retracement. I take a significant low, so the significant low is here. I take a significant high, and then I see how the market has retraced from that point. So you start from here, and how have these two lines played out? You find resistance on the first line, and you pull back to a higher low. That's bullish action. And then you move up to this line, really 2 hits in here, and then find support at an area that was resistance. That's what you're looking for. When you break resistance, you want to find either a big move to the previous level. At this point, it was 1030 or 1029, or you want to find support. Now, when it broke this resistance in here, there is this magnificent support that was found. It had to run higher, and then several more support tests. And then, of course, the week that ended was starting to break out. Very bullish signs. A lot of reasons to be getting into a chart that was looking like this. And, well, of course, it's been nothing but up since that point. In fact, if we go back to 2011, which means that we're starting from this point in here, well, the prices just went straight up. There's one trend line in here. We're going to talk about trend lines in a couple of videos as well, but it just kept on going higher and higher. And if you look at this chart in itself, you notice that you make a peak. This peak hit that upper band, and then it had a little bit of a correction. Then you make this high, didn't make it to the band, but then you have your bottom in here. Then you make a top period and a bottom in here, and you're just breaking resistance at this point. So again, when you're looking at a chart of this nature, there's a lot of reason to be bullish for the price action to continue to move towards the upside. And of course, now that we're looking today, it hasn't went back to this level, and it's went close to $2,000 an ounce as well. So now let's look at this from 1913. This is the yearly chart. So again, each one of these candles represents a single year. And I have a top part going to 5,000, mainly just to show you what the target really is and how not that much far to go really. In fact, if we take a look at the move from 1968 to, 1980, if we have the exact same move, as far as length is concerned, that would take us to $5,000 an ounce as well. And we're pretty much about halfway there. In fact, the way I do Fibonacci retracement is I take the level which we'd be going to, so 5,000 as a high. We started at 921, that's the low. So to find out where a 50% retracement is, I could put the number, which is a high divided by the low, which works out to 5.42, which is how many times higher I thought gold was going to go to, and put this to the power of 50% or 0.5. Again, multiply the low, which I think was 921, and that means 2145, which is close to where we've been already, is the halfway point of getting to the 5,000, at least as far as duration is concerned. As time, I don't know if we're halfway there. We probably already are, but there's obviously no guarantees within that. When I say soon, soon means obviously in the next so many years, but I can't say for sure exactly how long. Okay, when we look at this now, we're going to take a look at this on different time frames. Let's take a look at it from this bottom point here and see how the markets trade. It's obviously in a huge, massive uptrend. So let's take a look at gold, and we're going to use what we call the 40-day chart. Each one of these represents that of 40 days, or even for that matter, about 8 weeks of trading time. Let's talk about trendline analysis within this video, or this chart. What was the original trend line that got this market going back in the year 2001? Well, if we look back in here, we can see that we pretty much started doing this. So where have we been since we started this trend line? Well, obviously it has increased the rate of ascent. So what we're going to do is when a rate of ascent increases from the trend line, we have to determine where the next one is. We have to see where a starting point is on the next point. And I guess you could say that the second uptrend line was right in here. And then, of course, that one went higher. Now, the next trend line was something like this. So that's still no longer valid because that's up to the moon, we'll say. So the next trend line would be something like this. That's the third trend line that it is traded amongst, and it's holding up very well. And now we have this trend line here, which obviously broke below recently, but with the rallies that we've had, it seems as if it may want to regain that trend line. Again, with the last video, I was talking about the highs and the lows as well. So you have this high, this low, this high, this low, this high, and it's been going sideways. So what do you think is going to happen after it does end up breaking past this resistance point from this sideways consolidation of price? Well, the most easy answer is it's going to continue what bull markets do, make a pattern of higher highs and higher lows, and then, of course, go higher. Well, let's just take a look at this here, and we're going to reduce the time frame on this to the 65-hour chart. This will be the final chart that we're going to go over, actually. I'm going to be showing a lot of this chart on my channel over the next little while until this has been resolved. I'm waiting for a Fibonacci confirmation above this particular level. I thought originally I was going to do this video after it does the confirmation, but I thought to myself, if I'm so confident, and I am, that it's going to eventually break through and make significant gains, then I might as well comment on this now. Also, what I notice about trend trading or technical analysis is when you make a big high and a big low. So you move something, you're going up like this, and then boom, you go like this. And then after you make the high and the low, you have a decent pull somewhere closer to the middle part of the range. Then the question I ask myself is, what is it going to take out next? Is it going to be A, the high, or B, is it going to take out the low? Fibonacci retracement can really help determine what that would be. So we have this big high of 1921. That is the all-time nominal high for gold as I'm doing this video. And we have this low that occurred shortly afterwards. And then it went to the middle part of this range. So now what's it going to do? Is it going to take out this high, or is it going to take out this low? So now as we move forward, we can see that it made this lower high. And technically, it kind of did take out the low, but really it was a match. So nope, we didn't take out the low. Then we have another matching high and another matching low. And well, we're right back to where we were before. This is a sideways transition. Markets can correct either one of two ways. It can correct by doing the reverse, which the reverse of going higher is lower, or it can correct by going sideways. This is the definition of what a sideways market would be looking towards. Now for confirmation towards this, I'm looking for something from here on in to either have maybe a gain up to the 1800 area, maybe pull back to this level. It can pierce below it at 1758. And we would establish a resistance point from this point, maybe make some sort of pattern. And as it's breaking past this resistance that it establishes, that's when the confirmation will be coming in that the move from point A to point B has failed. And oftentimes on a failed move can create fast moves in the opposite direction. The opposite of lower happens to be that of higher. There can also be pullbacks from this point, and that's fine. In fact, if you go from this point here back to this point, which is 1664, and then you go back again to 1758, well, that would look extremely bullish to just go back and like that, because you'd have yet another test of this level. And again, when you break it, this thing will be ready to have significant gains. And if you have, say you have this previous resistance that you go towards at 1920, you hit the level, maybe come back, and then you break through it. Watch out, there's the new gains you're going to see, and it could be months before it corrects, either through a price or time correction. And I'm going to end the video right now. So a lot of charts were shown. Again, there's a lot of information available on the internet. Do your own research, do your own due diligence, and have yourself a great day. Bye-bye.